Hey, what's up, everybody? Welcome back to Investing Sucks and welcome to the year 2024. I hope your year has been going great so far and you all had a great holiday season. I did take some time off of YouTube. I took about a month break just to, go back and catch up with some friends and family and overall just take some time off. But I'm back now and I'm ready to start up the regularly scheduled programming for this channel. And I wanted to kick things off by revisiting a commitment that I made to you guys about a year ago where I said I was going to try the deep value investing strategy because I'd talked in the past about how I did some back tests of deep value investing and I studied past examples of deep value stocks and I was trying to look for characteristics that distinguish the winners from the losers. And the result of that study was pretty much what you'd expect. There were certain factors that you can look at which historically would lead to below average or above average results, but there was by no means any clear-cut answers, no absolutes in the world of investing. However, there were some pretty clear factors that you could point to that could easily weed out the poor deep value investments, and also some common traits that I saw in the ones that ended up being very successful. So I want to talk about that a bit more in this video. But really, what I noticed and what was the key reason why I wanted to look into this strategy a bit more in depth was because basically with the method that I was using, it created a short list of about, say, 20 or so companies where a few of those companies ended up producing very, very strong returns, 30+% compounded returns for a period of about 3 to 5 years. And that's really the whole draw of deep value investing is kind of that asymmetric risk reward ratio where you're protected on the downside. And then if the company is able to turn things around, you have plenty of upside. So this video is basically going to be kind of like a progress update on, what I've done so far in my search for a good deep value investment. And I also want to show you a current example of a deep value stock that on its surface, it appears to be valued so ridiculously cheap that it almost makes you question everything you know about investing in finance. But once you actually do a little bit of research and you start to peel back the layers, and it is more technical research that you have to do, but eventually you do realize why it's valued the way it is. So I want to go through that example with you guys. So the way that I get this initial list of deep value stocks, which is kind of the starting point of my research, was I was using my website here, which is called Tickernomics.com. You guys probably know about this website if you've been watching me for a while, but if you are new to my channel, this is a website that I created, which has financial data on companies from all around the world and a whole bunch of different stock exchanges. And we developed this scripting methodology, which basically allows you to run custom analytics on companies. And these are public scripts. So these are scripts that were either created by me or other users of the website and people are using for, different reasons. And the website is currently free. So if you'd like to check it out, it's tickernomics.com. I will leave a link in the description as well. But the most popular public script that we have is the net stock. So the net stocks is basically companies that have net current asset value that exceeds their market cap, right? So there's a built-in margin of safety there because net current asset is meant to be a conservative estimate of their liquidation value, which if that's above their market cap, then in theory, you're very much protected on the downside. So we have over 140 people have actually used the net stock script. And then this one, which is a bit less popular, is the net stocks revised. Because what I was noticing with just the net ones was there was a lot of companies from specific countries that were appearing, a disproportionately large amount of time. And so I wanted to exclude those. And then also certain industries were appearing a lot. For example, biotechs were making up something like half the list. So I just removed those and made this revised version. And you can run this directly on the site and it will produce a list of a more filtered down version. And then there's also another script, which is net stocks with positive income, which I believe it's this one here, net stocks with positive earnings, because a lot of these companies are also burning cash. They're losing a lot of money. Personally, I wouldn't only want to look at companies that have positive earnings because there are some, even though they have negative earnings and they're burning cash, there's still enough of a margin of safety to where it makes a bit more sense. But that list is also available. So yeah, once I run that and then I open the insights table, it gives me the list right here. And it's a big list. But yeah, this is kind of the starting point for my analysis. So this was kind of the starting point of this analysis. And then what I did was export this into Excel. And then once I had all of them in an Excel list, I would go through each individual one and try and quickly weed them out as fast as I could. So the first thing that I would look at is, was the company actually a net stock? Meaning, was the data that I have here actually accurate? Because there are cases with companies, especially a lot of these smaller and international companies, where due to currency conversions or something like that, the data could be slightly off. So I first wanted to confirm if that the current assets and the market cap numbers were actually accurate. And that could weed out, some of them, not a lot of them, but what did weed out a lot of them was basically if you just look at their cash burn rate relative to how much net current asset value exceeds market cap. So for example, if there's a company that had their net current asset value was $20 million above their market cap, but you looked at their cash burn rate and they're burning about $25 million in cash per quarter, then it kind of makes sense why they're a net stock. It's really just investors are expecting that once they release their next quarterly results, the net current asset value is going to go down because of that cash burn rate. So they're not actually a net stock. It's really just because they haven't reported financial information in a while. So those were kind of like fake net. So I weeded all those out, and that weeded out probably 80% of the companies that you see on the list. So pretty much all the companies that are highlighted in yellow were weeded out for one of those two reasons. And the companies in green were companies that I actually decided to look into further because the margin of safety that they had was real. It actually existed and the data was indeed accurate. For example, this company here, Keytronic Corporation, so they had net current assets of 327 million, total liabilities of 261, so that's 66 million in net current assets, and their market cap was just under $50 million, and they actually had positive net income. So that was one that, is a bit more interesting because it proves that the margin of safety does actually exist there. So then once I had shortened down this list even further, I would go through a series of questions that I developed when doing those previous back tests of the strategy to try and determine, is this company more likely to be a good deep value investment or a poor one? So yeah, I'll just go through the questions real quick. So the number one, the most important one is this a company that I can understand, right? And this applies to all investing strategies, right? Never invest in something that you don't understand because you're not going to be able to understand why it ends up doing well if it does or why it does poorly, which, exposes yourself to a lot of downside. So that was number one. And then, does the company sell commoditized products? This would basically indicate, is this a cyclical business or not? Because that just makes it much more harder to predict. Now, that doesn't mean it's going to have poor investment results. And actually, what my back test showed was that companies that do sell commoditized products were more likely to have very strong results, but you kind of had to catch them at the right time. You had to catch them at the right, cyclical peak, which is difficult to do, right? Obviously, that comes down to more than just deep value investing. That's, having really good foresight into a specific industry. And then what is the makeup of the net current asset value? Is it mostly like cash and short-term investments, or is it 95% inventory that's just very slow moving inventory that they're having difficulty selling and they're probably gonna have to take a write down on, which is why they're a net stock in the first place. There were a few examples of that, and I'd say companies like that you can pretty easily weed out because, again, it just makes sense why they're valued the way that they are, and it's less likely that there's some kind of mispricing, right? Investors probably aren't mispricing it if there's a very obvious reason why they're valued like that. Unless, there's some dispute about how much they can actually sell for that inventory, but that's a pretty difficult analysis to do. And then also, is the company burning cash? So we talked about that before. But if they are burning cash, is the margin of safety, which is the extent to which net current asset value exceeds the market cap, is that enough to still make it okay, right? So say if they're burning 5 million in cash per quarter, but the margin of safety is like 30 million, then that's still a little bit okay. And then this is more of a general question here, but why is it a net? So if none of these other questions identified why it's a net stock, figure out why it is. There's always got to be a reason, right? Because it doesn't really make sense why a company would be valued on a net basis. So there has to be some kind of reason. And then sometimes that would reveal what the reason was, and I would either keep looking or move on. And then, by the way, I was doing this with a company here called Allied Gaming and Entertainment, so you can see some of my answers for them. I didn't answer all the questions yet. But could this company get crushed by Amazon? So that's another interesting one. Are they like an e-commerce retailer? And, for whatever reason, management still believes that they can compete with Amazon, but they're probably not going to be able to, and eventually they're just going to go to zero. There was a few examples of that, not many, I think maybe like two or three, but that was an interesting question. Does this company sell a product or service that is about to become obsolete in 1 to 2 years? So when I was doing this back test previously, a lot of companies that were appearing were basically companies that sold testing kits for a certain pandemic that occurred. So companies like that, you can pretty much assume, they're probably valued as a net because within a few years, um, they're not going to be around most likely. Now, this one was a pretty interesting one. Is the company controlled by a majority shareholder or a group of, related shareholders? And the reason that I brought this one up is because the whole reason that the margin of safety exists with these types of companies is because in theory you could liquidate the company, and even in that scenario you're still going to turn out okay as if you're buying into them, on the deep value basis, like as a net stock, right? Because the whole point of net current asset value is it's kind of like liquidation value. But if the company is controlled by a majority shareholder that refuses to sell, and they're insistent on keeping things going in the business, and they're not really taking the necessary steps to change things, then that ultimately doesn't matter, because you can't, invest in the company so that you gain control. Or there can't be, say, a group of investors or an activist investor that gains a large enough share to basically force the company to liquidate, which does happen sometimes. So there weren't many, but there were some companies that were definitely like that. Usually international companies that were owned by some other international conglomerate that just for whatever reason they want to keep their stake and they're not changing things in the business. Now, this one, has management been selling off their productive asset base, or do they currently have plans to do so? So, say if it's like a small oil company, right? And they're starting to sell off some of their assets, they can no longer go back to a stage where they're earning, a large amount on their assets, right? Because they've sold it off. So there's no potential for future cash generation there because they don't have the assets to generate cash anymore. And that also explains why they'd be a net stock sometimes. So that was something else to look out for. Again, this is a very one-off example, but I think it is a useful question. Mainly applies to like commodity type businesses. And then the last one, this one's pretty general as well, but has management been doing anything shady? So if you look at their financial statements and you go to the related party transaction section, or if you look at their corporate ownership structure, is it just too complicated and it makes no sense? And there's a lot of unexplained things going on. Because if there is, personally, I would avoid it because there's plenty of other companies out there that you can look at that don't have that going on, that just are pretty much normal with, relatively normal management and normal, no related party transactions going on. So if they have that and you're kind of looking at it and you're thinking this doesn't really make sense, personally, I would just move on. Um, and again, this is not a common thing, but it was something that I saw in a few examples. So that is the list of questions that I developed. Okay, so let's dive into a live example of a actual deep value stock, a company that's currently a deep value stock that I was looking into. So the company is called Dundee Corporation. They are a Canadian-based holding company that own a wide range of private investments, public investments, private debt, public debt, royalty interests, equity method investments, all sorts of different investment vehicles. And their portfolio is very odd. They're in a whole kind of like a random assortment of industries, but the vast majority of their portfolio, about 56%, is in mining companies, specifically like small junior mining companies. But then they also have holdings in real estate, asset management, biotechnology, waste management, and a whole bunch of different random industries. So it's a very weird holding company. Now, they're not actually a net stock. If we go here, we can see the market cap is currently about $60 million. And then if we look at their balance sheet, they have assets that total 320 million as of September 30th, and then liabilities of only about 17 million. So you can call it about 300 million in net asset value for a company with a market cap of only 60 million. So that is a massive discrepancy. And if we look at what it's been like historically, for example, if we go to the charts here, and we want to pull up this company's book value, and then just compare what their book value has been to their market cap over the years. And we can see this discrepancy has pretty much always existed. So MM capitalization is the symbol for market cap. So it's all the discrepancy has always existed, right? And their book value has kind of been decreasing gradually, and that's kind of flattened in the past 2 or so years, which at a high level, that kind of assumes that a lot of their investments have probably been losing value, and then their market cap has gone down along with it as well. So this company, it hasn't done great over the years, but even still with this, they're still valued at less than zero point 0.5 times the book value, which, it raises questions, right? Why does such a massive discrepancy exist? Well, when it comes to holding companies in general, it's not unusual to see them trading below their net asset value, right? There's this thing called the holding company discount, and it's a well documented phenomenon in finance. And basically, holding companies generally tend to trade below their net asset value simply because investors just disagree with how the company has valued their investments, especially if it's private companies. Because if there's no public market, no, very easily observable value that you can assign to an investment, then it's based on management's judgment. And the way they judge it is they do their own discounted cash flow of the actual company that they own, and then just multiply that value by whatever percentage they own. And then that's the amount that shows up on the balance sheet. And they do that every quarter. And if they believe that the investment has gone up a bit, so the company's been more valuable, then the value on the balance sheet goes up, and that gets recognized as a gain on the income statement as well. So it's very, very subjective. It's kind of one of those gray areas in finance or in accounting rather. And what you have with Dundee is basically a very extreme example of that. Which is why you see such the massive discount there. And a lot of Dundee's investment holdings are in private companies where, these valuations, they do get audited, right? The company does get audited by their auditors, but it's still subject to a lot of judgment. For example, one of their largest holdings, which I'll pull up here, is in a company called Tor RX, this company here, or TOR RX. And basically, this company is a private biotech company that is currently undergoing clinical trials to develop a drug that's designed to treat Alzheimer's disease. And because it's private, the value on the balance sheet was determined by, like I said, a discounted cash flow for this company. And every quarter they redo that DCF to determine if the fair value needs to be adjusted based on that. Currently, they've valued this stake, as we can see here, $65.3 million. But this valuation, it's very dependent on basically the drug passing clinical trials, getting regulatory approval, and getting to a point where they can actually begin to commercialize it. So it's a very, binary outcome, and the valuation is very dependent on that happening, right? So if you're a investor looking to do a valuation of Dundee, which is what I was trying to do here, and you're trying to be a little bit more conservative, you're probably not going to assign much, if any, value to this company. Because they even say here, it's reasonably possible for them to fail to win regulatory approval, and if so, it could result in a reduction of its carrying value to zero, which means the company's basically worth nothing. So personally, I would value this stake as zero if I'm taking a more conservative approach, just because you don't know enough about this company. I'm not a biotech investor either. I pretty much try to avoid those companies altogether. So I would value this at zero. So that's, of the 320 million in total assets, that's about 65 million gone just right there. And that's just one company. Now, this is probably the most extreme example that I saw. But there are, plenty of other private companies and public companies they own. So that's just one example of why they appear to be so undervalued. But even if you remove that investment entirely, they still appear to be very, very undervalued, because that would put their net asset value at around, say, $250 million. But their market cap still, remember, is about $60 million. So basically, what I decided to do was go through all of their assets and all of their investments one by one and try and do my own assessment of what I reasonably think that investment is worth. And I tried to be, very conservative, but also still fair. So I wasn't just going around valuing everything at zero. I tried to actually give some credence to companies that had real value. And interestingly, they do actually own some publicly traded companies. These are about 6 publicly traded companies that they own as part of their investment portfolio. And Excel has this functionality where you can pull in live stock data for these companies. So what this table here is basically a live valuation of what their current holdings are in those companies. So it's just under about $100 million. You can see about 98 here. which is down about 6 million from September 30th, which was their most recent reporting date. So, and you can see they're pretty much all penny stocks, right? They're all like junior mining companies. So maybe some of the discount is because investors just don't really want to own these companies in the first place. They don't really want to own a portfolio of junior mining stocks that are penny stocks that they don't have much faith in. But this is, pretty indisputable value, right? Because these companies, as of today, are worth this much on the stock market, which means together they're worth about just under 100 million. So that I counted all of that value. I didn't do any discounting there. But I'm not going to go through all of this one by one because it is going to get very detailed and I don't want to take this too long. But one additional thing I want to mention is one of their equity method investments. So, for those of you not familiar with, the specific accounting rules for this, these are investments where the investor doesn't own majority control in the company, but they don't own, a very minuscule amount, like say 1 or 2%. They own a substantial amount, so say 20, 25, 30%. And the accounting for these works a bit different. They're not actually valued at fair value. So they don't just look at what that stake is worth as of now on, say, the public market, or if it's private, what the private stake is worth. It's accounted for a little bit differently. It's a bit complicated, so I won't get into the specifics. But basically, the point I wanted to say here is it's possible that there's hidden value if there's a discrepancy between the way the accounting works for these equity method investments and, say, if it's a public company, what it's actually trading for on the stock market. So there's a company called Magna Mining, and this company, it is a public company, and they own 21% of it. So the current carrying value, so what the value of this company is showing as on Dundee Corporation's balance sheet, is 8.3 million here. But what the actual market value of their 21% interest is just under 18 million. So there's about 10 million in, hidden value there, which is interesting because even though we're going through all these investments and most of the time we're marking them down from what we think they're worth, this one we actually mark up, right? And this is just indisputable value. It's, what it's trading for on the stock market right now. So I included that. And then basically in the end, we get about a revised asset value of 220 million. So it went from about 300 million to 320 million to 220 million. So about 100 million markdown. Now, what happens when we subtract out all of these liabilities, right? So this is all the liabilities showing on their balance sheet. Well, we get this adjusted book value, which is kind of like a sum of the parts valuation of $200 million. Their current market cap, like I said, in Canadian dollars, it's about $80 million. And so that means on a per share basis, we go here, the adjusted book value per share is 2.37. Their current share price is 0.93. So that represents 155% potential upside, right? Based on this very conservative valuation of all the assets. So you look at that and you think, okay, even despite, everything that's wrong with this company, all these, weird private investments where some of them are worth zero, in terms of indisputable value, for example, from public companies and then also from various other like royalty interests and some private holdings, there still is enough value to make this company worth it. But there is a catch to this. So, for one, this company has something called non-controlling interest. So, because they are a holding company, there's about 5 companies that they own, which I think I'll show you these companies actually. So I'll go to the MD&A here. There's about, I believe it's, yeah, so these companies here, 5 companies that they either own 100% of or they own majority control in. So we can see the ownership percentages here. So all of these companies, they have to consolidate on their financial results. So when we look at their income statement and their balance sheet here, they basically present this as if they own 100% of all of these companies, but they don't, right? They own 100% of 2 of them, but then there's 3 of them that they don't own 100% in. So the way that this gets accounted for, that percentage that they don't own is something called non-controlling interest. So if we go back to our Excel file, we have to bring in this non-controlling interest to actually reduce the value a little bit, right? So that brings it now, our upside down from 155% to 144%. So even with that, you think, okay, still pretty good, right? I mean, that's still plenty of upside there. But that's not the only thing you have to consider. The other thing that's wrong is they have preferred shares. Now, I don't know if this is common for holding companies to have preferred shares, but this one's pretty simple, right? Preferred shares rank ahead of common stock on the liquidity preference scale. So you also have to, if you're trying to do a valuation of what their equity is worth, you have to account for that as well. So I just took, what the value of that, of the preferred share it is, like the par value on the balance sheet, and then put it in there. And they are paying, dividends on these preferred shares. So it's something you have to account for. And if you're just simply looking at book value, it's probably something that you could miss, right? Because say if you're looking at a price to book value, the price aspect, so the market cap is going to exclude the non-controlling interest, the percentage of those companies that they have to consolidate that they don't own. But the book value, if you're not careful in calculating the book value, it could include that. So it's going to appear like they're more, undervalued than they actually are. And then you also have to account for the preferred shares because that would also show up in equity, but as a, common equity holder, you have to remove that. But even still, right, 58% upside, that's still pretty good, right? And again, I was very conservative in going through all of this. But let's say, for example, with these private securities here, so these are other private investments that they own. What if we just remove this? What if all of those are worth zero? Now it's only 19%, right? And they also have private debt, right? So what if their private debt is worth, I discounted this at 40%. What if instead these are in junior mining companies with, they all face solvency issues. They can only collect, say, 30% of that. Now it's 12%. So you can see kind of why the valuation starts to make a bit of sense. I mean, it still does appear to be undervalued based on everything, but it makes a lot more sense and it's not as egregiously undervalued as it initially looked. So really how you could view a company like this is, okay, they have all these public securities which are worth, we know what those are worth. But if they were to try and sell everything, maybe if you add on the tax consequences of everything, they're no longer undervalued. So with this company, this isn't one that I would probably invest in just because I can understand why it's valued the way it is. It may be a little low, but I can still understand it. So anyways, guys, that pretty much does it for this video. I hope you did find this useful and insightful. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you would consider subscribing, and I'll see you guys in the next video.